Thanks for listening to Investor Insights, a behind-the-scenes look at investing with Fund That Flip. This series provides an insider's look at how our business works and answers your frequently asked questions so that you can make better investment decisions with your hard-earned capital. Now, our founder and CEO, Matt Rodak.
Welcome to this episode of Fund That Flip's Investor Insights. I'm your host, Matt Rodak, founder and CEO here at Fund That Flip. It's been a while since we recorded an Investor Insights, and the world has certainly changed quite a bit. Today is Monday, April 6th, and we're starting what I believe is the fourth week of some form of quarantine, extreme social distancing here in New York City. First off, I hope you all are staying safe and you and your loved ones are all well. The health implications of this awful virus are quite serious, so please stay safe. All right, so the effects of the virus and related shutdowns are certainly having a profound impact on just about every part of the economy, I think it's safe to say at this point, and real estate investing is no different. So we thought, what better time than now to dust off this podcast series as another medium to communicate with our investors, really trying to let you guys all know what we're seeing in the market and generally, provide some insights into how to navigate the current environment. So in addition to the podcast, this podcast, we've been posting a series of blogs on our website. We'll be refreshing this content pretty much on a daily basis as things continue to evolve and take shape. So I'd encourage you to check those podcasts out over again at fundthatflip.com. So we've been fielding a lot of questions from investors about what's going on and how to be thinking about things now that we're in this new environment. So I wanted to take some time to answer some of these questions, these more common questions, and we'll be doing more of these things, this type of content again as things continue to take shape. So let's start with rates. One of the most common questions that we're getting is what's going on with rates, and it's probably because it's one of the most noticeable differences, if you've been with us for some time, is the sudden change in rates, right? Prior to the COVID breakout, most of the loans on our platform were offering investors, anywhere between 8 and 9% returns. In just a few short weeks, those rates have gone up to, call it 11 to 12%. So what gives? Fair question. Well, one of the nice things about our marketplace business model is that we are able to adjust pricing in pretty much real time to keep supply and demand in balance. So prior to COVID, there was a lot of demand from investors for our loans, which had the effect of pushing rates down. Another way to say this or think about this is there was more capital seeking yield than there were loans to fund. So rates compressed. Now, if you've been with us from the beginning, right, really back to 2015, 2016, you may remember that when we got started, our rates were pretty consistently in this 11 to 12% range. So over that time, the market matured, more investors learned of this asset class, more capital came into the space and drove rates down. Things have changed, right? And there are a lot of factors at play here. The stock market has repriced, creating some attractive entry points for equities. Spreads on bonds have widened, creating some new opportunities there. And generally, what we're seeing is people are seeing or perceiving there to be more risk in the market, not just our market, but the market at large, right? Before all this happened, and all of this is equating to investors demanding a higher return relative to the perceived risk for them to make investments. And it makes sense. So again, one of the nice things about our marketplace business model is that we can be super dynamic with our pricing and adjust in real time to meet the market where it's at. And that's what we're doing now, right? We're seeing investors are demanding a higher rate of return, right? So in order for us to have a functioning marketplace business, which we think we have, is we've got to meet investors with where they're at on their return. So the good news is if you liked the loans before, now you're able to earn a better return on your investment. We're a little unsure of how this plays out in the long term, but for now, we're seeing the market price around 11, 12%. And again, because we can be pretty flexible, given our marketplace model, we're meeting the market there. So hopefully that answers the question on rate. Again, we don't know how long this will last, but at least for now, the market is repricing around that 11 to 12% range, and that's where we've met it. So that's rates. The second question that we are getting a lot is has to do with whether or not construction is continuing to progress on these projects given the shelter-in-place orders in many jurisdictions. So I'd first like to be clear and say that this is changing literally on a daily basis and is very much a state-by-state specific thing. So in some states, construction has been deemed an essential service and is allowed to continue. Ohio is a good example of that right now, right? Ohio is allowing construction to progress. That could obviously change. But as of right now, some states have deemed construction as an essential service, in which case things are kind of business as usual. Other states have said, hey, we got to pull back on construction work, until a later date. So again, it's changing on a daily basis. We will be putting a list together based on what we know that we'll be updating periodically, and again, posting that on our blog at fundthatflip.com. We've got a whole section dedicated to COVID-19 and resources there and information specific to what's going on with this. So we're going to add that list to the blog on where construction is still permissible, again, based on our understanding and what's going on and having conversations with our borrowers. So short story is, yes, construction is still progressing in some states. Other states, it's not. Where it's not, obviously, we have been in contact with our borrowers to make sure that we are properly securing the job sites to protect the property. And while shutdowns are not ideal, if we need to do them to help this thing go away, let's do them. That said, we do expect this to be a relatively short-lived thing, right? I think in many cases, work can still be done at a property while safely social distancing by limiting the number of people on the job sites and keeping things sanitized. So we think over the next couple weeks, 2, 3, 4 weeks, probably at the most, we're going to get some relaxing of some of this, particularly on larger job sites, and hopefully get people back to work. Regardless, the result of all this for the states that have created these stop work orders is it's going to take a little bit longer for our borrowers to finish the work, list the property, and get it sold. So we are, advising investors on our platform to just consider that, right? That these projects across the board are probably going to extend a little bit longer than we initially thought they would. Just as obviously this stay-at-home and shelter-in-place orders are jamming a lot of things up. In some cases, that's applying to the loans that we've originated. We'll be keeping a close eye on this and keeping you appraised if you've already invested in projects. We'll be starting to update those notifications that we periodically do with which projects are still going and which ones have been been temporarily put on hold. We'll also be making some of this information more available to projects that are currently open for investment. So if this is an important determination for you on whether or not you'd like to invest, keep an eye out for the platform to be updated here real soon with that type of information. Again, based on what we know at the time of the posting, things are changing quickly. All right, so that's is construction still progressing? In some cases, in a lot of cases, yes, in others, no. And again, we'll be providing additional information around which projects that applies to. Next question we're getting a lot of is Fund That Flip offering borrowers any type of forbearance program or making other accommodations. Look, these are certainly unprecedented times and unprecedented circumstances. Our intent always is to do the best we can to keep incentives aligned between borrowers and our lenders, and that's going to continue to be the case for us in terms of how we manage risk and keep things pointed in the right direction. We have found that this has served us very well historically, and expect it will serve us well even in these somewhat unprecedented circumstances. So, again, the reality is that most borrowers are just going to need additional time to complete the renovations and disposition of the property. We'll be working with our borrowers to assess their individual circumstances of the project and what's happening in their jurisdiction. And then at the end of the day, taking a common sense approach to developing a workable solution forward, right? So again, as a lender, full transparency, I think it's safe to say that we should be expecting most loans to be extended beyond their initial maturity date. And we think that creates the most optionality and will help optimize the end result for everyone involved. So again, unprecedented times. I think for the most part, people understand that time is going to be our best friend here, and we're going to give people the time they need where it makes sense, to get their projects finished and to an outsell on the back end. Kind of along those lines, another question that we get is, do we expect borrowers to stop making interest payments during this time, or are we allowing borrowers to forego making interest payments? And again, there's been some headlines out lately. Certain states and other regulatory bodies have announced, call it interest payment holidays during the quarantines, where they're allowing, certain types of people to not have to make their interest payments. We're investigating this. Is again something that's evolving on a daily basis on how these rulings, may or may not apply to our loans. We believe that the intent of these rulings are to protect homeowners and residents from being displaced from their homes during these unfortunate times, which we are 100% supportive of. Our loans, in most cases, right, are secured by properties that are not occupied. These are homes that are being renovated and are commercial in nature. So we believe these interest payment holidays are not intended for our type of loans. So the advice that we're giving to our borrowers as of today is that we believe it's in their best interest to continue to make their interest payments, as this is going to allow us to, be more flexible, be more accommodating if we need to on extensions. For those that are continuing to work, they need construction draws, which means we need to be, current pay in order to advance those construction draws. So again, our position on this is we don't believe these interest rate holidays apply to our types of loans. And our advice to our borrowers is, hey, keep making payments. You're going to make them anyways. These assets aren't cash flowing. And by making your interest payments and remaining current, it's going to give us the most optionality on, again, taking a common sense approach to getting to what we all want, which is the project finished and the home sold. All right. So it's kind of forbearance and interest. We'll be keeping a close eye on those things as well. The next question is, how should I as an investor be thinking about after renovated values, right? ARVs now, right? What impact might this have on housing values and demand and supply, and ultimately kind of all the fundamentals of the underlying asset that our loans are secured by? This one is admittedly, more difficult to answer. And if I knew the answer to this question, I'd be a wealthy guy, I think. I think there's still a lot of people trying to figure out what the long-term economic implications will be of the virus and all of the subsequent shutdowns and impact that it's having on our economy and the global economy. What I will offer you is I had the opportunity to speak with Ali Wolf, who is the chief economist of Myers Research. These guys do a ton of work in the residential real estate market. They advise a lot of home builders. And we had a really good conversation. We recorded it. It's a podcast where we talk about, different, potential outcomes and different scenarios of, how this potentially plays out. So rather than try to repeat that whole conversation, or Ali does a much better job than I ever would of explaining those different scenarios. Again, fundthatflip.com. Our podcasts. Look for the podcast with Ali Wolf of Myers Research. It will have been posted right around the same time as this podcast. So yeah, there's obviously a lot of uncertainty in the market in terms of what does this do to housing, and I think this level of uncertainty is another one of the reasons, right, why we're seeing higher interest rates being passed through to investors. Right, uncertainty means a little bit more risk, and we think the compensation for that is a higher rate. So check out that podcast with Allie. I think there's a ton of great content in there about what all of this means for housing, and was a really good episode that I enjoy. I always enjoy talking to Allie. All right, so the last one here is that we're getting is what impact does all of this have on Fund That Flip's business operations? And heaven forbid if this continues and goes on for a long time, what happens if Fund That Flip goes out of business? Fair question. You guys are investing on our platform and want to make sure that we are a going concern and can continue to service your loans. So what I'll say to that is we raised a round of venture capital in August of 2019. We've since then also secured some additional financing from a bank and are in process of taking advantage of the CARES Act and applying for an SBA loan. And beyond that, right, we also have a history of financial discipline. We've grown the company from, before we closed the latest round of venture capital from 2016 to 2019, we grew the company by over 6,000% on just over $2 million of seed capital. So we know how to stretch a dollar. We've operated very lean, leading into our latest capital. We're obviously keeping a very close eye on our financials and are remaining nimble and adjusting, accordingly during these uncertain times. At the end of the day, we believe we're well capitalized to weather the storm. All of that said, I think now is a good time to also remind everyone of the bankruptcy remote structure that we implemented in 2016. Right. So again, you can check out more about how this works on the blog, but I'll give kind of the cliff notes, if you will. The way this works is we have an agreement in place with an indentured trustee, and we have a separate, wholly owned SPV, special purpose vehicle, right? So it's a totally different company, LLC, where all of the mortgages get originated into and all of the borrowed dependent notes, which is the note that you guys purchase as investors, go into this SPV. The indentured trustee and the indentured trustee agreement has certain events, one of which is if Fund That Flip goes out of business or becomes insolvent, this third-party indentured trustee steps in to protect the cash flows of those underlying assets and make sure that they go back to the right place. So again, the indenture agreement is a document that is available to you online. I'd encourage you to read that in the PPM and understand how these different things interact. But the intent of the structure and the reason that we set it up back in 2016 is when you guys are investing on the platform, you're investing in real estate risk. And what we want to do is separate that real estate risk that you're investing in from the operational risk of a early stage startup company, right? So by having the SPV, having the indentured trustee, we believe we create what's called a bankruptcy remote structure so that if anything does happen to the company, the assets that are underlying the notes that you're subscribing to get a clean break off with a third party to manage how those funds will flow back to the right place. So again, fundthatflip.com, check out our blog, more information about how that works there. And as always, if you got any questions, feel free to reach out to investorrelations@fundthatflip.com, and we'll set up a call to walk you through anything that may be unclear. All right, so that's it for now. I hope you found this information helpful. This is obviously a very fluid situation and things are changing quite quickly. We'll be putting out more content like this, podcasts, blog posts, nearly on a daily basis to inform you of what we're seeing in the market and how we're adjusting. We continue to be long-term bullish on the housing market in this space. I like to remind people, and we'll leave you guys with this, that going into all of this, we had record low single family housing inventory. The statistics from the last month they reported was just over 3 months of inventory. Healthy numbers are 5 to 6 months. So fundamentals from a supply side are very strong going into this. While the demand side of the equation is still somewhat uncertain, we do believe that the relatively lack of supply is going to help provide some support for housing prices going into the future and once we come out of this. So I'll leave you that tidbit. As always, it's our goal to offer investors fair risk-adjusted returns. Things are obviously changing and we're adjusting with them while also providing the utmost transparency. So We hope that you'll check out open investment opportunities at fundthatflip.com and reach out to us at investorrelations@fundthatflip.com. If you have any questions or would like to speak with me or someone from our investor relations teams, we'd be happy to set something up. Thanks for listening. Stay safe and happy investing.